Ever looked at a stock and seen P/E 25 and thought, what does that mean? Is that good or bad? Don't worry. By the end of this video, you'll know exactly what the PE ratio is, how it's calculated, and how it can tell you if a stock might be undervalued or overpriced. Let's keep it simple. No confusing math, just easy investing sense. PE stands for price to earnings. It shows how much investors are willing to pay for every $1 a company earns. To find it, take the current stock price and divide it by the earnings per share, also called EPS. For example, if a company's stock price is $100 and it earns $5 per share, you divide 100 by 5, and that gives you a PE ratio of 20. That means investors are paying $20 for every dollar of profit the company makes. But that number, 20, actually tells you a lot about investor expectations. A high PE ratio means investors believe the company will grow quickly in the future, so they're willing to pay more today. A low PE ratio might mean the stock is cheap or undervalued, or it could mean the company isn't expected to grow much. Here's an example. Company A has a PE of 10. It may be steady but slow growing. Company B has a PE of 50. Investors expect it to expand fast. So a high or low PE ratio doesn't make a stock good or bad. It's all about growth expectations. Now, here's where things get interesting. There are actually two types of PE ratios. 1. Trailing PE. This uses past earnings, usually from the last 12 months. It tells you what investors are paying based on what the company already earned. For example, if Apple earned $6 per share last year and its stock price is $180, divide 180 by 6, and you get a trailing PE of 30. That means investors are paying 30 times last year's profits. 2. Forward PE. This one uses expected future earnings, what analysts think the company will earn next year. If Apple is expected to earn $9 per share next year, then 180 divided by 9 gives a forward PE of 20. That's lower than the trailing PE, meaning investors expect profits to grow. So, trailing PE looks at the past, forward PE looks at the future. Smart investors don't just look at one PE number, they compare it. They compare a company's PE to its industry average or to its own history. For instance, if a tech stock has a PE of 25, but most tech companies are around 40, it might be undervalued, maybe a hidden opportunity. But if a slow-growing energy company has a PE of 30 while others are at 10, it could be overpriced. Always remember, the PE ratio tells you what the market thinks about the company's future, not just what it earned in the past. So in short, the PE ratio is a quick snapshot of investor expectations. It tells you how much people are willing to pay today for a company's profits. A high PE ratio usually means growth and optimism. A low PE might mean value or risk. Use it to compare, not to predict, and you'll start seeing which stocks are truly worth their price. If this made investing clearer for you, hit like, subscribe, and share with someone who's learning about the stock market. See you in the next video.